Hi, and welcome to another episode of Entrepreneurship Uncovered, the three things you ought to know. I'm Gabby Luoma, CPA, CGMA, and CEO of Mod Ventures. I will be facilitating and joining in this discussion with Sarry Ibrahim, a financial advisor who can support all 50 states and Puerto Rico. Before we get started, let me tell you a little bit about Mod Ventures. Mod Ventures is an outsourced accounting and advisory company for businesses across the United States. Our accounting team is fully virtual and has been since 2014. Our passion is to help entrepreneurs organize, create, and predict their financial futures. We believe that strong small businesses create financially stable communities. I'm so excited to have you today, Sarry. We connected a few months ago and really started having those discussions around different strategies around tax planning. And we're very investment minded. And so when we started talking about how we like to see our clients invest back in themselves, whether it be retirement planning or, purchasing equipment or, focusing on automation and investments there, we just love that conversation. And so I'm so excited to, get into this conversation with you. So, sorry, why don't you give us a little bit of your background and tell us what you do?
Yeah, well, Gabby, thank you so much for having me on your podcast. It's a pleasure to be here and speak to you in the audience today. So a little bit about me. I'm from Chicago, Illinois, and I have a company called Financial Asset Protection. So it's a full service financial services firm. We do all types of strategies like financial consulting, coaching, budgeting, retirement planning, all types of insurance planning. And as you mentioned, we're present in all 50 states as well as Puerto Rico. It's a 100, pretty much like a 99% virtual/remote agency. So a lot of our meetings are over Zoom or over the phone. I only have a few clients I met with in person in Chicago. But yeah, it's a pretty much a virtual practice. And then we also have the podcast called Thinking Like a Bank podcast, which is consistent with our views on financial literacy and financial planning. We're also big believers in reinvesting back in your business. And I think that one of the things that stuck out with our conversation when we spoke last month was when people think of like financial advisory, they think of like stocks, bonds, and mutual funds. And that could be relevant in some situations. But I think real financial consulting and real financial advisory is helping people with money. That's like that should be the real definition of it. So yeah, it's a pleasure to be here on the podcast, and we could talk about all sorts of strategies.
Yeah, no, I love it. I think that that's definitely what we're about, like helping people with their money, right? And, ours happen to be, organizing, creating some plans and predicting financial futures. But, as a CPA myself, I've always kind of not gone into where I call myself a financial planner because that means different things to different people. And so,
Yes.
You have CPAs who do plan and do a great job at tax strategy, and then you have CPAs who don't do that. They just really stick in there with the tax preparation. And so, I've always tried to position our firm as thought leaders in that realm where we're really trying to help our clients do that type of planning and think about their money a little bit differently. So I appreciate that um, strategy, and I think that's what we do. We help people every single day, and so I love that you have a bunch of strategies that maybe I haven't even heard of before. So, why don't you tell us what are the types of things that you're doing to support your clients?
Yeah, definitely. So one of like our agency's influence came from the bank on yourself concept. A lot of people especially in real estate know it as the infinite banking concept. So what it is that it's a strategy for you to become your own source of financing, and it's a way for you to grow wealth outside of Wall Street. So that's not all we do, but that's one of our core products, our core investment strategies that we help clients with.
Mhm.
And then to kind of like break down like what it is, it's a way so it was originally invented or introduced in Nelson Nash's book called Becoming Your Own Banker. And in the book, Nelson Nash, the author, talks about how he had about, forgot, it was like $500,000 in debt, and he was paying about $80,000 a year just in interest alone. This was back in 1980 when interest rates were much higher. And then he kind of discovered that this was a pretty common problem with people who utilize a lot of debt, is the amount of interest they pay to other lenders. And they discovered a way where he could use a specially designed whole life insurance policy that has cash value. So that way he could refinance those loans back into his policy. And then now he is essentially the bank in that situation. So that's how it was originally introduced. It then led to the bank on yourself concept, which was invented by Pamela Yellen. And then that concept is very similar. It talks about how you could use cash value whole life insurance to be your own source of financing, to build wealth outside of Wall Street, outside of, the typical stocks, bonds, and mutual funds. And then it kind of led to like our firm using it for business owners. So a lot of business
Yeah.
owners use this strategy. They build up these policies and they borrow against the policies, reinvest in their business.
Yeah.
And then you being a CPA could probably imagine like the tax benefits with that, right? So typically the whole life policies are growing tax free, the loans are tax free, the withdrawals are tax free, and they're using that money to then reinvest, getting certain tax deductions in their business. And
Mhm.
then so it's like this never ending cycle of like compound growth.
Yeah.
So that's kind of one of the strategies we help clients with.
That's interesting. So, as far as, size of your company, does it make sense for, um, let's say, a company that's maybe just getting started? They're kind of expecting maybe they're going to be top line revenue of 300,000. Does it make sense for a small company to take advantage of this particular strategy? Or is it really for much larger companies, let's say million plus, to implement something like this?
Yeah, good question. So unlike other strategies out there, it's a very neutral strategy. There's really no requirement. You could do a strategy like this with as little as like $200 or $300 a month. So you can imagine, sole proprietor with like, 100,000 revenue, gross revenue would probably be able to afford this with
Yeah.
$200 or $300 a month. And then all the way, you can scale it all the way to, Fortune 500 company, or a large bank, size. So it's really flexible because of the strategy. The strategy itself is it's a flexible financial strategy. You could do with a few $100. You could do some policies where you're only paying into it for like 7 years or 5 years or 10 years. So I recommend it for everyone because it's more of a concept than it is like an end product. And what I mean by that is it's a way of living. So like if you could imagine, it's like asking, when should somebody save? And when you position that question, it's not really dependent on how much money they make or how big their company is. It could be a proportion. It could be 5% of revenue or 10% of revenue. So same thing with the strategy. It could be a small portion of your overall gross income, or gross revenue, and then you could use it, and then you could scale with it. So as your company grows, and then these strategies also help you grow your strategy. A lot of our clients who are business owners and real estate investors have been able to scale their businesses and grow their businesses because of their ability to consistently have leverage, to consistently be able to leverage their accounts and not have to rely on banks.
Yeah. Well, I mean, the banking industry right now is like going through tremendous amount of turmoil,
Yeah.
and with interest rates rising and things like that. I think, you know, um, we want to support our small business owners, and I think our policies want to do that. But I think there's been a lot of, different
Mhm.
situations, interest rate being one of them, that's made it more difficult for the small business owners to invest and do it in a way that makes sense. So I like this strategy. Now, is there any specific industry that you see that it's super powerful in, versus, small trades versus medical practices, professional services? Is there any business that you would say this is most ideal for?
Yeah, really good question. So, it could be for any industry, literally any industry you could think of. I think it'll help probably the most for industries that have uh probably more rapid cash flow. Like for example, some professional service industries, it's the cash flow might be a little bit longer. Like in my industry, for example, like in the financial advisory insurance world, it could take like a year to get paid from a client. Whereas like in a higher volume industry, like in manufacturing and distribution, you could potentially, every day have cash flow coming in. So I think those businesses would probably be a little bit better because of the amount of cash flow they're handling, and they could recoup that into their policy. on a weekly or monthly basis that can go into the policy. But I don't want to say that it doesn't work for, other types of businesses. It does. It works for really any business. I just think that the preferable businesses are the ones with higher cash flow and more rapid and consistent cash flow.
Right, right. Yeah. So you're saying, ones that are, seeing like medical, you're seeing clients every
Yeah.
single day. So you're getting paid every single
Yeah.
day. And so you can pay back
Yeah.
those policies more quickly, maybe,
Yeah,
potentially.
exactly. Yeah, you could have more predictable premiums that go into the policy, as well as when you borrow from the policy, more predictable loan repayments. Although when you take out a policy loan, you don't have to pay it back. It's not like a traditional loan. Like, for example, if I go to a bank right now and I borrow, let's just say $10,000, the bank is going to want a payback structure. If it's a closed-ended loan, like a personal loan or a business loan, they're going to want some sort of payback structure. With these types of policies, when you leverage a whole life policy, there is no direct payback structure. You could pay back as you want. You could pay back annually, monthly. You could pay back in the next couple of years. So it works really handy with business owners who are on tight budgets, and they don't have to commit to payback structures. Also, the loan you take out, it's a non-recourse private loan. So it doesn't show up on your credit report, credit score, doesn't impact any other loans you have. And then when you do go and get other loans, it doesn't affect that underwriting. Because one of the main things, right, in underwriting for loans is prior debt, like especially like in mortgages. Like if you want to get a mortgage, one of the first things your loan officer and the underwriter is going to look at is other debt you have, and they're going to do the math to figure out if you can afford their mortgage. And that's
Right,
a big reason why people don't get approved for mortgages, is because of their debt to income ratio. So
right.
if you if you have debt from a whole life policy, it doesn't impact those types of loans.
Wow, that's a really great point too. Um, I think that that's one of the things that people don't even think about, like in this type of strategy, they're just thinking about, hey, I need some money. Like, how am I going to do
Yeah.
this? Um, so, in my years of being in business, we hear about term insurance and then we hear about whole life insurance. And I've always heard that whole life insurance is quite expensive. So,
Mhm.
what is your thoughts around, the term type of insurance versus the whole life type of insurance? Obviously, you need whole life in order for this to work, but maybe the advantages of going that direction instead of term.
Yeah, that's a really good question, a good point too. Is that you're right. A lot of people do think of, when they think of whole life insurance, they think of a more expensive insurance. And it could be that way. There are about 2,000 life insurance companies in the US, and
Huh.
all of them have different variations of whole life insurance, different riders, different, premium allocations. There's different way to structure them. So it's possible that yes, whole life can be more expensive than term insurance. However, there's different ways of structuring. And this is where the bank on yourself strategy comes in, is that there are specific companies we use and specific types of products or types of life insurance products within those companies, and then specific ways of structuring those policies. So we can structure policies in a way where they are very cost efficient. And then the way you would measure, like in the insurance world, or especially in the cash value life insurance world, the way you would measure whether something's expensive or not is in relation to the amount of premiums you're putting in versus the cash value. So that means, let's say, for example, you buy a policy for $100,000 a year, and that's your premium that goes into it, and then your cash value is $100,000. Essentially, that was a 0% cost, because your cash surrender value is equal to your premiums. So that policy costs you nothing in that situation. Of course, the policies don't work that way. So, like, for instance, a more reasonable or more practical way would be, you put 100,000 in premium, or let's just say 10,000 in premium. I think that's going to be more reasonable, 10,000 in premium, and then your cash value year one might be 7,000 in cash surrender value. So that's not bad compared to traditional whole life policies. So that means that if you put 10,000 in year one, and then you surrender the policy at the end of year one, your cash surrender that you take away is 7,000. So there was a 3,000 loss, right? So that means that in year one, your policy costs you $3,000. Let's just say that it was like $200,000 in death benefit. That means you pay $3,000 for 200,000 in death benefit.
Gotcha.
Now, with these policies, we structure them so that way they'll break even in like year five or year six. So year one, you're putting 10,000, year two, 10,000, until like year five or six. And then now your cash value is approximately equal to the premiums you put in. So essentially, after year five or year six, there is no cost of insurance. Now it's essentially a gain in the investment. It's not necessarily an investment; it's more of a saving strategy. But now there's a gain, and if it's structured properly, it's a tax-free gain. There are no taxes on life insurance, dividends, or interest you earn in a life insurance policy. So now you're beyond a break-even point. So now the policy is gaining momentum. It's growing more than you put money into it. So to answer your question, it could be expensive if it's not structured properly from the right company. And then you end up, unlike term insurance, you end up recouping the cost of your insurance.
Yeah.
So what I mean by that is if you did like a 30-year term life policy,
Mm-hmm.
99% of the time, if 100 people took out a 30-year term life insurance policy, 99 of those 100 people will end up outliving the 30-year term, or canceling the 30-year term,
Yeah.
or converting the 30-year term into a whole life policy. So only one of them will actually pass away within that 30-year period. And then their beneficiary would get the life insurance amount, which means that 99% of the time, a term life insurance policy is just there, just because, like, it's there
Yeah.
just in case you pass away during that time period.
Right.
So, and if you think about it from that perspective, it means that all the premiums spent were complete, like a sunk cost. It was complete
Yeah.
loss. Like there was nothing gained from that.
Right. Yeah. Yeah. I know. We've had life insurance on my husband for 20 years and he's still alive. So
Good, good, yeah, it's good, yeah,
that's great. No, that's good. I'm
yeah,
glad he's still alive, but for sure,
yeah,
we've been spending, and it started, of course, when he was younger. So it was like $50 a month, but $50 a month for, 20 years. Um,
yes,
and so, yeah, so I can see the benefit of that. So we covered, specific industry, we covered size of business. Um, and then, I'm assuming you take care of all these strategies. So once somebody, like decides that, yeah, I want to bank on myself,
mhm,
um, you guys design then the strategy to make sure that it's makes sense. And it sounds like it's a little bit more of a longer term strategy that you want to do over a course of a few years instead of just one. Like it doesn't make sense to do it just for a year. It's something you want to do for
yeah.
a longer period of time.
Yeah, exactly. Yeah, that's a good point. Yeah, it's a long-term strategy. It's something you want to structure for a longer period of time. I would say like at least at minimum a 10-year outlook. And
Okay.
it's not something that can, like, for example, solve like a retroactive problem. It's something like you can go back in time and like solve. Because I think that we do come across a lot of clients in that situation where they're reaching out, like they have a current issue, some sort of financial struggle, and they need to use a strategy to solve that problem. Sometimes it depends, but most of the time it's not going to. This is something more of like planting seeds for the
Yeah.
future. So it takes a big mindset shift, right? Like especially if you're constantly in that momentum of like, all right, I'm gonna call, my insurance agent to get a lower quote. I'm gonna call my accountant to save taxes this year before I pay the IRS. So everything you're doing is kind of like retroactive and like instantly, like instant saving,
Yes.
instant.
Right.
Having that mindset is not gonna help you with the strategy.
Right.
This is going to be more of like I said, planting seeds for the future.
Mhm. Yeah, no, and I like that too, because we like to think out, 3 to 5 years if we can.
Yeah.
And it's difficult with tax law, right, to do that
Yeah.
because
Yeah.
they are constantly changing. So that we're always having to stay kind of abreast of the new things that are happening. But it's a good idea to look out a few years to see where you want to be, especially, if you're starting to think about succession planning and
Yeah.
where you'd like your business to be. I think there's some, big steps that have to be done, and investment, right? In order for
Yeah.
that company to look attractive to future buyers, there's investment that's needed. And so, sounds to me like this could be a good um, investment strategy around, even helping and investing for future like succession planning and such. Would you agree?
100%. Yeah, 100%. Yeah. I think that one of my clients slash friends was asking the other day, he's like, if a business owner is really successful, does he still need to talk to you about like financial advice? And I was like, absolutely. Like, so that's the big misconception too, is people think that you only go to a financial advisor when you're not savvy with money. Like,
Right.
and that's not true at all, because there are different aspects, right? Like,
Mhm.
there's the tax planning strategy, which I'm not a tax professional.
Right.
So you need somebody on the tax planning side, not just the tax prep side, but also the long-term tax planning
Yeah.
side. You need somebody to help you with retirement planning. And there's also a big one that a lot of people overlook, and that's estate planning. So estate
Yeah.
planning is essentially what happens when you die.
Yeah.
And of course I get it, because that's the last thing usually on your mind. But it's crazy. I'm in the CFP course right now, the estate planning course with the CFP
Okay.
program, and it's just like mind blowing, because it talks about all these things that you usually wouldn't talk about. Like, for instance, let's say somebody was just 100% pro real estate. Like, all they wanted to do was just invest in real estate. And let's just say they accumulated this huge net worth, or this portfolio of like $100 million in real estate properties. And then anything to do with insurance, anything to do with stocks, bonds, mutual funds, they're just like, get it away from me. I don't want to talk about it. I don't want to even talk about cash. I want to just talk about real estate. And
Right.
that could be good. I see the attractiveness there. But what if that person has $100 million net worth and then they pass away now? They're for sure above the estate planning limit, which I believe is like 13 million in 2023. So
Yeah.
now their beneficiaries, their personal representative, their executors going to have to pay these taxes now, a huge amount of taxes, like 40%
Yes.
above that limit, above the $13 million limit. 40% of that is going to be exposed to estate planning. That's almost half your money is exposed to estate taxes.
Right.
So in that situation, since real estate is an illiquid asset, you have to now sell real estate. And as you know, selling real estate when it's not your choice is probably one of the worst things to do,
Absolutely.
because if the real estate market is up, you're losing now the potential appreciation, and if the real estate market is down, you're also losing the potential appreciation of
Right.
the future. So
Yeah.
it's always like the worst. So what if you had liquidity in place to pay those estate taxes, such
Right.
as life insurance? And
Yeah.
almost every financial advisor or accountant would tell you, in an estate planning situation, life insurance is the best liquidity aspect.
Yeah.
It's instant cash within 30 days from a life insurance company, and
Right.
usually the life insurance amount is a much greater multiple. So that means it's like $1 to 10 or $1 to $20 ratio over time, of course,
Sure.
that will eventually out. So just something to think about. There's more to it than just your current business.
Yeah.
There's this is where holistic planning comes in. There's more to the financial plan.
Yeah, your whole life cycle, really planning for that
Yeah.
whole life cycle, and even thinking past your particular life, into your children's lives and grandchildren's, and what type of legacy you want to leave for your family. I think that's super important to bring up as well. Um,
Mhm.
so yeah, it's mind blowing all the planning that can be done. Um,
Yeah.
so what does it look like to work with you guys? And how can somebody like get started? What does it look like? First thing.
Yeah, definitely. Yeah, thank you for that. So, first of all, we would have like an intro meeting, like a 15-minute free call, just to see like we're a good fit to keep continuing on with the process. And then if so, then we go to the second step, which is a financial analysis meeting. It's typically 60 minutes long over the phone, and it's simply me understanding your financial situation, like where you're at, income wise, projected income, your goals. It's not so much of just data driven, but also like what you think about money, what you think about retirement, what you think about what's going on in your life and your goals. And then after that meeting, then I would use the information from that to present a solution. And then in the solution, we would present, it could be either using the infinite banking system, it could be a passive real estate opportunity, it could be we look at also tying in the accountant or other financial advisor if their focus is a different focus, or sometimes even their attorney if they want to do things a little bit more strategic, like
Sure.
changing LLC or changing S corp or things that are beyond our scope, obviously.
Right, right,
um and then after that, the client would either implement one. Typically, we'd like to do one strategy at a time, because it takes time to do these things. So like it would be
right,
too overwhelming to tell the client like 10 different strategies. Usually, they won't do nothing. If you give a client too many things to do, they won't do anything at all. So we like
right.
to do just one strategy, and then we even like to space it out. So it's like one strategy every 6 months to 1 year,
Yeah,
depending on what it is. It's broad to say that, but we like to space it out so that way things are getting done. And then after that, we'd have a 6 month to 1 year, every 6 months or every year, depending on what the client needs, follow-up meeting. So another, it's usually an hour long. And we go through like what we talked about previously, and we match it to what's happening. And it's always going to change, right? People's goals and their plans are
yeah,
always going to change, but it's
yeah.
just important to change the plan with their changes.
Right, right. Definitely. I think that's a really good strategy, because things do change, and people are constantly changing, and, they get new mindsets around money, or, thought
Mhm.
processes that come in, they're exposed to something new, or they have questions. I think that's a good thing too, to only introduce one thing at a time. We tell clients, just come to the first onboarding meeting. We will walk you through everything,
Mhm.
just to make
Yes.
sure that they know that they have a partner through this whole process. So I think that that's super important. The onboarding is like 99% of client
Mhm.
experience. So I love that you guys tackle it that way. So um, I have loved this conversation. I have learned so much from you. So thank you so much for coming on and, kind of giving us all those different strategies. Um, if somebody wants to get a hold of you, what would be the best way to get a hold of you? And, what is their next step? What do they need to do?
Yeah, well, first of all, thank you so much for having me on the podcast. It was a pleasure talking to you. I enjoyed the questions you asked. If listeners want to reach out, they can go to thinkinglikeabank.com. It's thinkinglikeabank.com. And then you can actually reach out. There's an option to schedule a free 15-minute call. And if you do so, I'll send you a free copy of the book, Becoming Your Own Banker by Nelson Nash. So to get that free book, just go to thinkinglikeabank.com and then schedule a free 15-minute call.
That's awesome. Thank you so much. I mean, I'm sure that the value of just having a conversation and providing those extra tools is going to really, really help our viewers get to know you, and then get to know this new idea as well. So, thank you all so much for coming and spending your time with us today. We really appreciate the time because we know it's valuable. And if you liked what you saw, please give us a thumbs up. And then if you have not subscribed yet, please smash that subscribe button. We will be including show notes in the bottom, as well as links to Sarry's website and our information as well. So we will see you next time. Here's to your success.